The banks are clearly nervous that if we had a choice to have their bank accounts, which they gamble with, or to have accounts that they babysit for us with CBDC in them, which they aren't allowed to touch, well, the big banks are afraid that we might choose the safer option.
And that is why we have a fundamental concern with a retail CBDC, given the flight to quality risks.
Flight to quality risks. What a quote! They're afraid that we would fly on over to accounts with higher quality than the risky crap accounts that they offer, which are the only kinds of bank accounts we currently have available to us now. Put another way, the banks are afraid of competition. Competition from a safer product.
I am so damn tired of being lied to. I don't think I can deny it anymore. You can stick to your story if you think it flies, but I'm not gonna buy it anymore.
Hello, my friend, and thank you for listening to the 283rd episode of the ad-free, listener-supported Congressional Dish podcast. I'm your host, Jennifer Briney. And it has now been 2 weeks since I published episode 282. And as of this recording, the House of Representatives is still shut down. And there's no signs of it reopening anytime soon. And also, during that time, a terrorist attack in Israel has set the world on fire. But during all of this time, our Congress simply hasn't been working. The House literally can't, and the Senate just chose to go home for 2 weeks. And so even though I know that current events are intense and serious and scary right now, our Congress has done nothing about it. And instead of guessing what they're going to do, which is all any congressional reporters can do right now, I'm going to turn us away from all of it for today. Because in general right now, I feel powerless. But there is something going on in our government that, one, we should be aware of, and two, we do have the power to influence, as this issue is still in the debate stage. And so let's talk about that today. And so for this episode, you're going to hear testimony from 3 hearings dating back to the spring of 2022 in the House Financial Services Committee about the possibility of the Federal Reserve creating a central bank digital currency here in the United States. 2 of the hearings featured members of the Federal Reserve, and the most recent hearing featured a panel of experts who debated the pros and cons of the United States having digital cash, or something like that. But this is a fascinating topic. And if you want to watch these hearings in full or find any of the sound clips that I'm playing for you today so that you can hear them in context, we have links to the full hearings and timestamps of these clips in the show notes for you on congressionaldish.com. But I know that you probably don't have time for 7-ish hours of hearings, and so this episode is intended to save you that time and give you the highlights so that you can get the gist of the debate and either jump further down this rabbit hole or form an opinion using this episode and share it with your member of Congress. Because on this issue, this is so far off of most people's radar that I think you can make a difference on this one. The main hearing that I'm going to highlight for you today, the one with the experts, which was a true debate, that hearing wasn't aired on C-SPAN, which means that it wasn't aired on any televisions in the United States. It was put on YouTube, but the YouTube counter is just a bit over 3,000 views as of this recording, which is just a fraction of this podcast's audience. And even the hearing room itself was almost empty, even though Congress was debating changing the nature of money. This seems like something that shouldn't be so far off the radar, and yet it is. Which means that your phone call probably won't get lost in a sea of phone calls about this topic, unlike some of the other topics Congress is fielding calls for lately. And so let's get into it. Here's what's going on. So the Federal Reserve is considering issuing a central bank digital currency, which the Federal Reserve defines as, quote, a digital liability of a central bank that is widely available to the general public, unquote, and which is, quote, analogous to a digital form of paper money, unquote. They're essentially saying that this would be a digital form of cash. And in the conversations you're going to hear today from the hearings, the central bank digital currency that they're debating is going to be referred to by its abbreviation, which is CBDC. So every time you hear CBDC, think this digital cash thing from the Fed. Now, today, Federal Reserve notes, so, physical currency, the cash in your pocket, well, those Federal Reserve notes are the only type of central bank money available to the general public. And in January 2022, the Federal Reserve published a paper titled Money and Payments, the U.S. Dollar in the Age of Digital Transformation. And that paper outlined their current vision for a CBDC should they choose to create one. In that paper, they said, quote, a CBDC would differ from existing digital money available to the general public because a CBDC would be a liability of the Federal Reserve, not of a commercial bank. Commercial bank money has very little credit to liquidity risk due to federal deposit insurance, the supervision and regulation of commercial banks, and commercial banks' access to central bank liquidity. Central bank money carries neither credit nor liquidity risk and is therefore considered the safest form of money, unquote. In other words, our money is only safe in banks because of government insurance, government regulation, and government loans. And a CBDC wouldn't need insurance, policing, or bailouts, therefore making it the safest form of money. Representative Stephen Lynch of Massachusetts, who seems very much in the pro-CBDC camp, here he is with his vision for the role that a CBDC could play in our society.
A CBDC is just one type of publicly issued digital dollar and would be issued, backed, and regulated by the Federal Reserve and have the full faith and backing of the U.S. government. This could serve as an alternative to existing forms of payments and have a benefit including instant payment settlement, provide a medium for cross-border transactions, and foster greater financial inclusion. More than 130 countries have begun to explore their own government-backed digital currencies. China, Russia, Saudi Arabia, and India have already commenced pilot programs, and a digital euro pilot could be launched as early as 2028. Meanwhile, the U.S. remains far behind amid increasing and blatant information about features of digital currency. While concerns about data privacy and government surveillance are real, especially in countries that do not respect human rights and privacy, a CBDC does not have to be designed that way. We could employ an architecture that would protect personal data while including anti-money laundering and terrorist financing features.
So as Representative Stephen Lynch sees it, the design of a CBDC is key. And he seems to suggest that a design that ensures data privacy and limits government surveillance is possible here because the United States is a country that respects human rights and privacy, which he says as if the war on terror, torture of foreign civilians, the Patriot Act, the PRISM program, which is the program during which our government partnered with tech companies to enable the U.S. government to collect and store the digital data of quite literally the entire world. Well, Representative Lynch says that as if the United States government never did any of those things. And so right off the bat, in his opening statement, we're being told that this is all okay here in the United States because our government isn't one of the baddies, which is an ignoring of recent history that I am just not capable of. Because during my adulthood, the protections afforded to the citizens of the United States via the Constitution, especially the Fourth Amendment protections against unlawful searches of our information and property, well, they just don't seem to exist in practice anymore. And so starting with the opening statements of this hearing, I'm having constitutional concerns. I mean, this is the very nature of money that's being debated here. And the Constitution didn't create the Federal Reserve. The Federal Reserve didn't exist before 1913. And so the idea that the Federal Reserve is going to change what money is, there are constitutional questions here about what is even allowed to be done by the Federal Reserve. And those questions have been pondered in public between members of Congress and the current chairman of the Federal Reserve, Jerome Powell. So here's Representative French Hill of Arkansas speaking to Federal Reserve Chairman Jerome Powell on March 8th, 2023.
Article 1 of the Constitution reserves coins and coin issuance, money issuance to the Congress. And we've in turn delegated that to the U.S. Treasury, which has, since 1912, engaged the Federal Reserve as their fiscal agent. You've testified here many times before that to issue a central bank digital currency, that would have to be authorized by statute by Congress. Is that still your testimony?
So that is absolutely the case as it relates to a retail CBDC. There are potential forms of a wholesale CBDC that we need to look at. It's less clear. But we've always been talking about retail CBDC, and that's something we would certainly need congressional approval for.
And what would be a parameter on something that's not a retail CBDC where you think that could be issued in some form or fashion without Congress's direct statutory authorization?
It would be, for example, it would just be something between banks. So it would look an awful lot like a bank reserve. And you might ask, well, why would we need it? And that's a really good question, too.
Yeah.
But just something that's literally within a wholesale market.
But that speaks that you might have a blockchain between banks and the Fed using a central bank digital currency token to settle transactions institutionally inside
Yes.
So the Federal Reserve Chairman seems to think they already have the authority they would need for a bank-to-bank digital currency, but anything that would be issued for use by the public, a so-called retail CBDC, would need a new law from Congress. And so Congress is having the debate. And the debate at this point is quite theoretical because here is where the idea is currently at within the Federal Reserve. Here again is Federal Reserve Chairman Jerome Powell testifying in March of this year.
We're not at the stage of making any real decisions. What we're doing is experimenting in kind of early stage experimentation. How would this work? Does it work? What's the best technology? What's the most efficient? We're really at an early stage but we're making progress on sort of technological issues. The policy issues are equally important, though. We haven't decided that this is something that the financial system in the country want or need.
Right.
So that's going to be very important.
So they haven't made a decision yet, which means we still have time to influence the decision if we want to. But the Federal Reserve has already put in writing the general parameters for what they're thinking about doing and how they would like a CBDC to be structured if they decided to move forward. And so the Federal Reserve's initial analysis published in January of 2022 suggests that a potential U.S. retail CBDC, so the digital cash kind, not the bank-to-bank kind, well, it suggests that if one were created, they said it would best serve the needs of the United States by being, quote, widely transferable, privacy protected, intermediated, and identity verified, unquote. And so let's break those down one by one. So first, transferable. The Federal Reserve says it would, quote, need to be readily transferable between customers and different intermediaries, unquote, which makes perfect sense. Like any kind of money, you have to be able to easily exchange it for goods and services, just like handing over cash in return for a burrito. This does not seem controversial at all. But then next, they talked about how it has to be privacy protected. And so to get us started with the privacy conversation, here's Professor Christina Skinner from the Wharton School of the University of Pennsylvania. This was her testimony in September of 2023.
Privacy rights are the clearest place to start. Today, individuals can enjoy comprehensive privacy in their payments transactions by using cash. Now, although most central banks have suggested that CBDC is not going to replace cash, that near-term promise can't be guaranteed over the longer term. And the insinuation that CBDC is necessary or inevitable seems motivated by a view that cash will eventually become obsolete. But because central banks don't have the technology presently to offer cash-like privacy, a digital currency, unless it's radically redesigned, will bring with it the ability for the state to monitor or surveil its citizens' payments activity.
Now, I know a lot of us who are middle class and above don't use cash very much. In fact, I just had lunch with some friends this week, and most of them said that they can't remember the last time they used cash for anything. But the fact is that lots of Americans do use cash, even if you're not one of them. The Federal Reserve's report said that according to a 2020 survey, U.S. consumers still use cash for almost 20% of total transactions. That's not nothing. And if there were a scenario where I wanted to keep a purchase private, the only option I would even consider is using cash. Because cryptocurrencies, all crypto transactions are recorded on a public ledger. So if someone figures out who owns the wallets on the ledger, they can figure out all of your transactions. So cash is the only truly private means of buying something without a digital record of the transaction. And I do think it's worth mentioning that wanting financial privacy does not equal wanting to break the law. So, for example, I want financial privacy for medical reasons, especially in a country where health insurance companies have been inserted as billing middlemen for the vast majority of us. And those middlemen make their money by denying us health care. And so I try to keep as much as possible away from the health insurance companies in case the Republican Party someday accomplishes their policy goal of repealing the Affordable Care Act. And then health insurance companies are able to deny us care for so-called pre-existing conditions again. I also want financial privacy so that I can reward some service workers more than others. So I've been living in hotels for the last 6 months, and I know that some people care more about providing great service than others. I don't want to tip digitally to those people so that some manager can divide the tips amongst the whole staff. I want to hand cash to the person who cleaned my room the most thoroughly during my stay, or to the person who said hello and gave treats to my puppy every time I saw them, or to the server who remembered my order every day at breakfast. I love tipping in cash, and the privacy of that transaction, with no boss or bank or government taking a cut, that's a part of why I want that. And so financial privacy, the kind that cash affords us, is something that I think, for perfectly legal reasons, is worth preserving. And supporters of the idea of digital cash, like Representative Stephen Lynch, as you've already heard, they say that a Federal Reserve CBDC can be designed to be private. They say a CBDC could be, technologically speaking, designed so that only the sender and the receiver would be aware of the transaction details. But the Federal Reserve is being crystal clear that they do not plan to design it that way, because the report said that a CBDC would need to, quote, strike an appropriate balance between safeguarding the privacy rights of consumers and affording the transparency necessary to deter criminal activity, end quote. And the problem with that is that you can't have a thing that is private and transparent at the same time. Those are opposites. And on top of that, the Federal Reserve is saying in no uncertain terms that their CBDC would be intermediated, as in there would be middlemen. The Federal Reserve's paper says, quote, "The Federal Reserve Act does not authorize direct Federal Reserve accounts to individuals, and such accounts would represent a significant expansion of the Federal Reserve's role in the financial system and the economy. Under an intermediated model, the private sector would offer accounts or digital wallets to facilitate the management of CBDC holdings and payments," unquote. So what that means is instead of having wallets with CBDC on thumb drives or cards or at the Federal Reserve, we'd have wallets with CBDC stored in private banks. And there was a lot of debate about the privacy implications of all of this during the hearing. And so here's some highlights of that debate amongst experts and members of Congress, starting with Representative John Rose of Tennessee, who's speaking to Dr. Norbert Michel, who is the Vice President and Director of the Center for Monetary and Financial Alternatives at the Cato Institute. And the rest of the experts will be introduced during this series of debate highlights.
Decisions in United States v. Miller and Maryland v. Smith gave us the third-party doctrine. Under that doctrine, if you voluntarily provide information to a third party, the Fourth Amendment does not preclude the government from accessing it without a warrant. Dr. Michel, can you explain how the third-party doctrine has impacted Americans' financial privacy?
Yes, they practically have none at the moment because of this, partly because of this. But I also want to clarify, because of something that was just said on the panel, the Fourth Amendment is, of course, that we're talking about is the one that amends the Constitution to the United States, which protects American citizens from the government. So, I mean, this is exactly the issue, and it was brought up in the cases in the 70s when the Bank Secrecy Act was challenged. If the Bank Secrecy Act were not there, the banks and financial institutions that we have would not be required by the government to collect the data that they are. That is a requirement in the Bank Secrecy Act. And that was always, you can go back, everybody can go back and look at those cases. That was always an issue as to whether this was constitutional and in violation of possibly the Fourth Amendment. So between the combination of the Bank Secrecy Act, the Fourth Amendment issues, and the third-party doctrine, Americans, although many of them don't realize it, have very little financial privacy at the moment.
How would the adoption of a CBDC further erode Americans' reasonable expectation of financial privacy?
I believe it would remove the last layer that we have, quite simply. Instead of having to go through the financial institution, the government would have that information either in a central database or a keystroke away.
My name is Yuval Ruz. I'm the co-founder and CEO of Digital Asset. If the U.S. government were to decide to issue a retail CBDC, unlike wholesale CBDC, I think that it is going to be critical for the government to show and evidence that there is no ability for the government to see transactions of citizens. I personally would be against such an act.
And Mr. Raul Carrillo is an academic fellow and lecturer at the Columbia Law School, where he analyzes financial regulation, technology, and innovation.
Today, I support the call for a digital dollar system, including CBDC, Fed accounts, and eCash. When discussing privacy, the digital dollar system and CBDC should be compared to the existing systems that we are already using. As has been pointed out, the private sector does not protect data security or data privacy sufficiently. Crude opposition to CBDC based on surveillance grounds with no comparison to a real baseline is blinkered and leads us to throw the baby out with the bathwater. Just 6 years ago, last Thursday, Equifax revealed it had been breached, granting hackers access to the personal sensitive information of nearly every adult in the United States, including those without credit scores. The fintech world of more sophisticated data brokers and super apps engages in data maximization as a business model and embraces unnecessary complexity that undermines data security. Of course, the Fed is also engaged in its data-intensive financial surveillance, often in partnership with big tech and fintech. That part has been left out of our conversation today. Here, the precise problem is that the doctrine and technological platforms that the government uses evade data collection constraints by acquiring data from private sector entities that are not ceasing to collect that data, whether their ledgers are centralized or decentralized. The major financial surveillance threat in the United States is not in the public or private sector per se, but in both, and more importantly, in the links between them. The digital dollar system presents a unique opportunity, I think, to actually build financial privacy and security in this country through public infrastructure that would benefit everyone. Indeed, the only way to evolve beyond the surveillance status quo is to establish a direct digital dollar interface with consumers where the Fourth Amendment and other protections may actually apply. If we truly care about privacy, we should treat the banking and blockchain industry appeals to partnership as suspect based on legal and technological grounds alone. We can build a retail CBDC and Fed account system with superior protections compared to what exists now and superior protections to the systems that are being built around the world currently.
So even the dude who is most in favor of a Federal Reserve CBDC acknowledges that partnerships between government and the private sector are precisely what have shattered any kind of financial privacy we maybe had once upon a time. And so while he's got a point that our country has the ability to create a CBDC on public infrastructure, that is not the Federal Reserve's published plan. Here's Representative John Rose of Tennessee questioning Lael Brainerd, who at the time was the vice chair of the Board of Governors on the Federal Reserve System. This was a hearing that took place on May 26, 2022, a few months after the Federal Reserve released their report outlining their vision for a central bank digital currency. And in this clip, you're going to hear Operation Choke Point mentioned, which was a program during the Obama years that was designed to choke out companies that were considered objectionable by the administration, such as payday lenders and guns and ammo dealers, despite the fact that these were all legal businesses. The goal of Operation Choke Point was to deny the businesses access to the banking and payments networks. So basically, instead of using the judicial system to prosecute the companies for breaking laws, or using Congress to change the laws to make predatory and dangerous yet legal business practices illegal, the Obama administration enacted economic warfare. They enacted sanctions against American businesses during Operation Choke Point, and that program has since been shut down. So here's Representative Rose and the Federal Reserve lady.
Vice Chair Brainerd, we saw how dangerous it can be when the government weaponizes the financial system for political purposes under the Obama administration's Operation Choke Point. More recently, the Canadian government instructed banks to freeze accounts linked to the trucker protests over vaccine mandates. Vice Chair Brainerd, without appropriate safeguards, would a CBDC make it easier for the federal government to block individuals it disagrees with from accessing the financial system?
So I really don't see a CBDC as raising questions that are different from, deposits in bank accounts, for instance. And the paper that was released in January, in particular, talks about an intermediated model akin to what we see with commercial bank deposits, where the central bank doesn't have any direct interaction with consumers, doesn't see transactions by consumers, but there are intermediaries, very importantly, including banks, that would be responsible for both identity verification and for keeping that transaction data private. So in that sense, I don't see it as really any different than the issues that are raised with commercial bank deposits.
And this intermediated setup is a choice, not a requirement, because it is possible to create a CBDC that would allow for anonymity, at least if Yuval Ruz, who is the co-founder and chief executive officer of Digital Asset, is to be believed. His company specializes in setting up blockchain infrastructure for multinational corporations.
If we wanted to have privacy included in the smart contract of the money, it would state that any movement of money would only be visible to the sender of money and the receiver of money, for example, and the issuer of money would be blinded. So all that the issuer would see is the overall balance, but would not see any underlying movements of the money, for example.
Smart contracts, that's blockchain. That's infrastructures designed by the crypto/blockchain community. And he says it could facilitate a truly private CBDC. But the current ideas floating around the Federal Reserve are not designed to use those new technologies. Quite the opposite, as some experts think the Federal Reserve ideas are designed to kill it. Here's Representative William Timmons of South Carolina speaking to Dr. Norbert Michel, who is the Vice President and Director of the Center for Monetary and Financial Alternatives at the Cato Institute.
Based on your research, can you explain what, if any, technological advantage a CBDC has over the private sector?
None. And this is properly viewed as a government reaction to a private innovation. You can call it Bitcoin, or you could just call it distributed ledger technology in general. That's what this is about. This is about the government seeing an innovation that possibly threatens their control over the payment system, and it is a movement to come up with something that takes that back. And it just so happens that what they're coming up with here is something that goes even further than where we are without the CBDC.
And the way that crypto was discussed by the people who are fans of the CBDC idea made me think that Dr. Michel might be right in his suspicion that this is a hostile Federal Reserve reaction to a new type of currency that they don't control. So here's a conversation between Representative Stephen Lynch of Massachusetts, the cheerleader for the creation of a CBDC, and the current chairman of the Federal Reserve, Jerome Powell, in that hearing that took place in March of 2023.
Before the greenback, everybody had their own currency. You had rail companies, you had coal companies, you had state banks that were authorized to issue their own currency. But when the greenback came out, all of those various currencies went to zero because everyone had, because the greenback had the full faith and credit of the United States behind it. I'm worried about a lot of these stable coins and other cryptocurrencies. Do they go to zero when we come up with a CBDC that has the full faith and credit of the United States behind it? And we've got thousands of these out there, and you've got people investing millions and millions of dollars in these, trillions right now. And I'm just thinking if we had those advantages built into a CBDC, wouldn't those alternatives go to zero if they did not have the transparency and the full faith and credit that we enjoy?
So certainly unbacked cryptocurrencies that don't have any intrinsic value but nonetheless trade for a positive number, those I've never understood the valuation of those. Stable coins are actually, many of them are really, they're drawing on the credibility of the dollar. They have dollar-based, they're dollar denominated mainly, and they have dollar-based reserves, although we don't know what's in the reserves because there's no regulation.
So the Federal Reserve Chairman admits a lack of knowledge about the value of most cryptocurrencies, which for a guy that smart seems to me to indicate a dismissal of the concept. Because I own cryptocurrency, thanks to the producers of Congressional Dish who gave me cryptocurrency, who literally invested me in it when I said, I don't know what this is and I don't really care. But you gave it to me so that I would have an incentive to give a shit. And well played, my nerds, because it totally worked. I've now produced multiple episodes about cryptocurrencies on this show, and I do feel like I understand the basics better than most at this moment in time. And one of the key benefits of them, which I do appreciate, is that there's no middleman between me and whomever I want to send or receive funds from. There are people, for example, who want to donate digitally and anonymously to this show. And I get it. I am fucking with the most powerful people in the world and doing it publicly. And so there are plenty of people who want to do a perfectly legal thing and support my work while not putting their name on it. And I think that's wise. I am a danger to be around. Maybe, I don't know. I think it's fine. But anyway, the people who send me cryptocurrencies, I have Bitcoin, Ethereum, which I really like for its smart contract capabilities. And I do have Litecoin as well, but I don't know anything about it, to be honest with you. But the people who have sent me these funds are almost all anonymous to me. And if they don't want to use a middleman company like Coinbase to make the transaction, they don't have to. The transaction can go wallet to wallet. And by the way, my wallet is listed on congressionaldish.com on the support the show page. But while governments can find ways to discover the owners of the wallets, it takes work for government agents to do so. So it's not as simple as having records with our names on them sent over from a corporation. And so in that respect, cryptocurrencies are the closest thing we have right now to true anonymous digital cash. And by the way, in DC speak, when they talk about that anonymity, they call it permissionless instead of anonymous, as in we don't need any middleman's permission to send the payment. I swear to God, half the job of Congress watching and reporting is playing the role of DC speak translator. But anyway, so when I'm watching this hearing and I hear Jerome Powell say he's never understood the value of most cryptocurrencies, I mean, even if he thinks that they are overvalued or even worthless, you would think the guy in charge of playing puppet master for the United States currency would at least have a basic understanding of why trillions of dollars have been allocated towards an asset, towards a currency that billions of people own and mostly sit on, but sometimes use. And so that read as a dismissal to me, because while he claims ignorance, he's also fine with the kind of cryptocurrencies that are attached to the US dollar, the thing he's kind of in control of. And then later in the hearing, Federal Reserve Chair Powell said this in a conversation with Representative Warren Davidson of Ohio. And Davidson is one of the members of Congress who is part of the unofficial group that's been nicknamed the Blockchain 8. But listen to this.
I think what we say about, I'll paraphrase it, what we say about permissionless blockchains is that they have been vehicles for fraud.
0.24%. So if you follow your own report on fraud, it's a fraction of what it is with the U.S. dollar.
Which we learned in our 264th episode of Congressional Dish, the one about cryptocurrencies and blockchain. We learned that that's true. And so as a refresher, here's Eric Lorber. He's the former senior advisor to the Undersecretary for Terrorism and Financial Intelligence at the Department of the Treasury. And here he is testifying to the House Financial Services Committee on June 16th, 2021.
The number of transactions which are illicit that use Bitcoin or blockchain technology is actually fairly low percentage-wise. It's, I believe, below 1% or somewhere around there. So it's fairly small.
And yet the chairman of the Federal Reserve speaks about blockchain technology and cryptocurrencies as if they're tools of criminals despite the facts, which I view as hostility towards crypto. And so while blockchain and smart contract technology could technologically facilitate a CBDC that allows for anonymity in financial transactions, a Federal Reserve chaired by Jerome Powell does not in any way seem poised to go in that direction. And then finally, the Federal Reserve said that their CBDC's vision is that it would be identity verified. So here's Blockchain 8 member, Representative Warren Davidson of Ohio, in the digital dollar hearing that took place last month in September of 2023.
The key characteristics of sound money is that it facilitates permissionless peer-to-peer transactions like cash. Currently, of the 100-plus countries developing a central bank digital currency, none of them are developing a permissionless system. Every one of them is developing a permissioned system, including the United States Federal Reserve. So when we talk about permissions, we can kind of get something from that from the Federal Reserve's own report of that. They said in their report that it should be privacy protected, intermediated, widely transferable, and identity verified. Mr. Michel, Dr. Skinner, Professor Skinner, in your view, is it possible to be both privacy protected and identity verified?
No, in my view, it's not. Once the information is in the system, it's in a system, and somebody's going to get it, and it's going to get out. I just quickly really want to say, I'm very happy to hear everybody here on the panel is pro Fourth Amendment. The problem, of course, as you know, is that the Bank Secrecy Act and the anti-money laundering regime runs right over the Fourth Amendment. So that's what needs to be fixed.
It's already a problem in third-party hands, but this wouldn't even be in third-party hands. But, Professor Skinner, what's your view?
My view is no, that's not possible right now, and central banks have essentially admitted as much. And to the extent such technology is or could be under development, it's extremely immature. And I think the point to emphasize here is that inherently there will be a trade-off to the extent central banks create CBDC between identity verification and privacy. And more than likely, central banks will always choose identity verification because they will never feel comfortable sacrificing the national security goals that they see as accompanying robust identity verification.
And indeed, the Federal Reserve's report said that, quote, financial institutions in the United States are subject to robust rules that are designed to combat money laundering and the financing of terrorism. A CBDC would need to be designed to comply with these rules. In practice, that would mean a CBDC intermediary would need to verify the identity of a person accessing CBDC, just as banks and other financial institutions currently verify the identities of their customers, unquote. And so the Federal Reserve's vision for a digital form of cash would not be anonymous like cash. A bank would be aware of the names of the sender and receivers of every payment, which means the Federal Reserve's current vision for digital cash isn't cash. It's much closer to a bank account than it is cash. But even though the Federal Reserve is saying clearly in writing and in testimony that the banks and other private companies, not the Federal Reserve, would be the middlemen who hold on to the CBDC for us peasants, the banks themselves are not actually on board with this plan.
My name is Paige Padano-Paradon, and I am a Senior Vice President and Senior Associate General Counsel at the Bank Policy Institute, a nonpartisan policy, research, and advocacy organization representing banks with over $100 billion in U.S. assets.
So she's representing the big banks. And here's some of her testimony and her response to a question posed by Representative Brian Steele of Wisconsin.
We believe that at this point, there is little evidence that a CBDC would bring measurable benefits to the U.S. economy or consumers. Furthermore, a CBDC could upend the commercial banking system and create financial instability. A CBDC, because it would be a direct liability of the central bank, it would be perceived as the ultimate safe asset. So from that perspective, particularly during times of economic stress, it could attract depositors to pull their money out of the banking system to flee or run to a CBDC if there was perceived concern about the banking system or the financial system overall. So every dollar that currently resides in a bank account can be deployed for useful purposes in the economy, primarily through lending. Every dollar that is pulled out and from the banking system and put into a CBDC is one less dollar that could be put to good economic use. And that is why we have a fundamental concern with a retail CBDC, given the flight to quality risks.
In your testimony, you wrote any transfer of a dollar deposit from a commercial bank or credit union to a CBDC is a dollar unavailable for lending to businesses or consumers. Can you expand a little bit on that statement about how an adoption of an intermediated CBDC how would it impact credit and availability and the cost of banking services?
Sure. I'm happy to. Thank you. So I think there's a misconception generally that a dollar transferred from a deposit account to a CBDC would that CBDC would still be able to be used for lending and investment in the economy the way that dollar deposits currently are now. And that is not the case. A CBDC, even if intermediated, in other words, even if the services, including onboarding and other services that commercial banks currently provide, even if those services were provided by banks with respect to a consumer's CBDC, the fact is the bank would really only hold that CBDC in the same manner it holds an asset in custody. So it would have to essentially keep that CBDC under the proverbial mattress, and it would not be able to be redeployed in the form of loans.
Fascinating, isn't it? That the banks don't support a CBDC because they wouldn't be allowed to use our money however they please. Because while she focuses on lending, when she says investment in the economy, well, that refers to the fact that banks use our deposits to gamble with on the stock market, which has been allowed since the banks were deregulated, since important banking laws were ripped up in 1999. And by the way, allowing banks to use our money to make bets on the stock market and to use packages of our loans as Wall Street casino chips directly caused the financial crisis of 2008. And so if we had accounts in their banks that they had to hold on to but couldn't touch, they couldn't have issued fraudulent or predatory loans using so much of our money and then mixed the junk loans with safe loans and then sold them on the market in a massive game of hot potato. If we had CBDC accounts instead of commercial bank accounts, our CBDC accounts would have been untouched by their bad bets, and maybe the taxpayer-funded bailouts wouldn't have been so easily approved since our money, our deposits, would have been safe. Maybe the banks wouldn't have been too big to fail. And so maybe the threat that the existence of a CBDC poses to the existing banking system is the best damn argument for creating a CBDC that we've heard yet. Because the idea that the banks couldn't lend money if we had CBDC accounts, I mean, even their lobbyists couldn't play along with that bullshit line. So here's Representative Sean Casten of Illinois speaking to the bank lobbyist lady.
If you had 100% CBDCs was all the M1 money supply, you'd have no lending, right? So doesn't any proportional increase in the amount of CBDC in an economy shrink the economy?
Well, there's there could be shifts to other forms of ways to fund lending. Banks could borrow in the wholesale markets. They could potentially borrow from the Federal Reserve. So I'm not necessarily sure it's a one-to-one relationship.
So the banks could still lend money. They just might not have as much of our money to play with. And we'd be the ones who would choose what kind of accounts to get. And the banks are clearly nervous that if we had a choice to have their bank accounts, which they gamble with, or to have accounts that they babysit for us with CBDC in them, which they aren't allowed to touch, well, the big banks are afraid that we might choose the safer option.
And that is why we have a fundamental concern with a retail CBDC, given the flight to quality risks.
Flight to quality risks. What a quote! They're afraid that we would fly on over to accounts with higher quality than the risky crap accounts that they offer, which are the only kinds of bank accounts we currently have available to us now. Put another way, the banks are afraid of competition from a safer product. Because I can tell you that if a CBDC were to exist and I had the choice of whether to keep my money in a CBDC wallet in a bank or to get a corporate bank account, the only way that I would choose to let the banks use my money, the only way that I would choose one of their riskier commercial bank accounts would be if they paid me. They'd have to pay me interest, and more of it than the 0% that they offered to us for about 15 years after the 2008 crash that they caused because they knew we had nowhere else to keep our money. And so the existence of a CBDC could cost the banks money because they'd have to pay us for the privilege of holding on to and being able to gamble with our money. They'd have to pay us to take on the risks that are inherent in their business model. And so this banker lady gave this testimony as if the risk to the commercial banking system was a bad thing. But I put this in the pro CBDC column, and I must admit, I find it compelling. But while I'm intrigued by the idea of weakening the power of the banks, I do wonder how this will affect the power of the Federal Reserve. And at this point, if you haven't already, I do think it would be good if you went back and listened to episode 201 about the Federal Reserve. It's very high up on our most valuable episodes list. The reason I produced that episode is that I tend to question things that other people don't, because I don't accept that everything as it is now is the natural order of things. And that is especially true now that I have learned about the Federal Reserve. To be completely honest with you, even though central banks are common all over the world, I'm not sure that our Federal Reserve should even exist, at least not in its current form. Because I'm definitely against the fact that the Federal Reserve, which is an organization made up almost entirely of bankers, is in charge of regulating the banks. There have been so many banking crises since the Federal Reserve was created in 1913 that the problems with letting bankers police bankers should be obvious to everyone by now. But the Federal Reserve having the power that it has over our money supply is also deeply concerning to me, even before it creates a whole new form of money. Because when it comes to the nature of our money, there were promises made back in 1913 that have been broken, the most significant of which was the promise made to the citizens of the United States that Federal Reserve notes, our paper money, would be backed by items of actual value. And at the time, that meant silver and gold. The citizens were promised that if the Federal Reserve was created, our money would never become a fiat currency. And yet 110 years later, a fiat currency is what we have. And in their paper, the Federal Reserve did promise that cash, the only truly anonymous form of payments, would still exist if they made a CBDC. I simply don't trust the people in this system to keep their word. And we have no way to keep the individuals in the Federal Reserve System accountable if they break promises or use their power over a CBDC to start doing governing things, like if they started sanctioning or funding citizens and companies directly. And so I'm concerned that this idea for a CBDC, if it moves forward, would not only change what money is again, but it would also change the power of the Federal Reserve. And during the hearing, concerns about changes to the power of the Federal Reserve were expressed by people who actually know what they're talking about. And so here's Professor Christina Skinner from the Wharton School of the University of Pennsylvania, and she's going to be questioned by Representative Mike Flood of Nebraska.
I'd like to focus on the impact of a CBDC on the Federal Reserve. Certainly, since 2010, the power and authority of the Fed has grown considerably, and Congress's responsibility to oversee the Fed requires it to understand how a CBDC could further empower the central bank, but also how it might weaken it. On the one hand, CBDC could result in a larger central bank balance sheet. Issuing CBDC would increase the liability side of the Fed's balance sheet if the total of bank reserves, repos, and cash balances largely remained unchanged. So if the liabilities with CBDC increase, so too must the Fed's assets. The Fed could buy more Treasury securities to match CBDC, but that could possibly invite pressure on the Fed to issue more CBDCs to in turn absorb more government debt. And overall, that dynamic could further erode the limited fiscal discipline that we have remaining. A CBDC could also affect the Fed's independence in the way that it would establish a direct relationship between the central bank and the real economy for the first time in history. One result of that relationship would almost certainly be the further erosion of the line between monetary and fiscal policy. Once central banks begin to issue liabilities directly to the people, it'll become much more difficult for the central bank to justify the provision of liquidity to banks and the financial system as opposed to households, especially during a crisis. And effectively, this could open the door to political pressure on the Fed to provide liquidity assistance to households during turbulent economic times. But these sorts of household-level interventions would radically transform the central bank and its purpose and role within society.
Ms. Skinner, in your testimony, you mentioned how a CBDC could lead the Federal Reserve's could lead to the Federal Reserve's independence being threatened. Can you speak more on that?
Yes, certainly. Thank you for the question. So in the first instance, to the extent the Federal Reserve doesn't change the composition of its balance sheet otherwise, issuing a CBDC will increase its liabilities, which means that it has to match that increase in liabilities by purchasing more assets. So the first thing that we would think about when the Fed would purchase more assets would be buying more Treasury securities. That being said, with the potential for the Fed to issue more CBDC, thereby giving it more headroom to buy more Treasury securities, would be likely to put some pressure on the Fed at some point down the line from the Treasury to issue that CBDC to absorb more government debt, which we call monetary finance or monetizing the deficit. And before World War II, the Fed essentially operated under the thumb of the Treasury so that during wartime and otherwise, the Fed could effectively monetize the deficit. And really today, that's anathema to an independent central bank. There are other things that the Fed could also be pressured to buy to match an increase in CBDC, like corporate bonds. Now, our recent experimentation in corporate bonds has put some question around whether this too could politicize a central bank, because inevitably, if central banks buy corporate bonds, they're picking winners and losers in the economy. Now, the Fed has been pretty neutral in its approach, but there has been a lot of pressure on the central bank to, for example, buy green bonds in order to facilitate a transition to a low carbon economy. And certainly other central banks do actively green their corporate bond portfolios.
And even if you support green energy, which it's no secret that I do, it's the idea that the Federal Reserve would be in the position to make those decisions, that an unelected group of bankers could make the decisions about what companies or people would get money and what companies or people would not. That's the concern. And as I sit here and contemplate this, the best argument I personally heard for a CBDC so far is that it would probably create competition for the banks and give us a safer storage of currency than we have now. But the Federal Reserve is staffed overwhelmingly by bankers. And so I do have to imagine that those concerns will be taken seriously, certainly more seriously than the concerns about our privacy and a quasi-government agency having a digital record of every financial transaction without even having to ask the middleman banks for access to it. I have to imagine that the bankers' concerns will be factored into the design of this thing in a way that our privacy will not. And so as I sit here, I guess I'm just struggling to see the upside. The people who were arguing for the creation of a CBDC, which was a group of Democrats in Congress and the one witness, Raul Carrillo, who's the academic fellow at Columbia Law School, their main selling point for a CBDC seemed to boil down to this. Here's Representative Maxine Waters of California and the pro-CBDC guy, Raul Carrillo.
130 countries representing 98% of the global economy are now exploring digital versions of their currencies, including the United States. Almost half of these countries are in advanced development, pilot, or launch stages of their CBDCs. Can you discuss how CBDCs may shape the future global financial landscape? What would it mean for the United States if we instead chose to stay on the sidelines of this race?
Thank you very much for the question, Representative Waters. My opinion is that it is incumbent upon the United States to provide leadership with respect to an inevitable process that is going to occur across the world. It is clear that we're all moving to digital fiat currency. The question is what sort of protections are going to attend digital fiat currency.
But is that clear? Is a digital fiat currency inevitable, like snow in the winter? Or is it a choice being made by humans in a government that, at least in theory, the citizens are supposed to control? And if this is the direction that we're going, should we perhaps start thinking of what kind of guardrails we want put up? Like, for example, maybe we should have a law that makes it illegal for the Federal Reserve to stop creating physical cash. Or maybe we need a law that limits what the Federal Reserve is and is not allowed to do with the CBDC, like limiting direct payments to companies and people. Or, I think more importantly, removing the ability for the Federal Reserve to sanction American citizens and companies, to cut us off from accessing our money. I think we have a role to play in the creation of a CBDC digital currency system, if that is where the Federal Reserve is heading. And I don't think we will be served well by trusting Jerome Powell and his banker friends to change the nature of money in the shadows. And there are some bills being written in the people's branch of government in Congress about a CBDC possibility right now. On the pro-CBDC side, Representative Stephen Lynch of Massachusetts, the fan of the whole idea, has written a bill which is supported by Raul Carrillo, the academic fellow at Columbia Law School. And here they are explaining the overall idea of what is in Stephen Lynch's bill.
The use of anonymous cash has plummeted, and more of our transactions are occurring online and under surveillance, tracked and aggregated by financial services companies. Indeed, China has turned that fact into a tool of full-spectrum surveillance of its citizens. This is why I've introduced the eCash Act. This bill directs the Treasury to design and pilot a digital version of cash and would complement the Fed-issued CBDC. It would allow individuals to make instant peer-to-peer payments with no consumer data or transaction tracking and without the use of a bank account.
So today, I also advocate for the inclusion of digital cash, as detailed in the Electronic Cash and Hardware Security and Secured Hardware Act, the eCash Act, reintroduced by Representative Lynch today. eCash devices available on a smart card or a phone card would serve as digital counterparts to cold, hard American cash. These devices would not make payments over the internet. Instead, they would store Treasury-issued digital dollars on card hardware to enable everyday small dollar transactions for everyday people. These transactions would be subject to the BSA AML regime, and as a boon to law enforcement, we can set privacy-sensitive security controls and caps on transactions and usage. However, the cards would in no instance be capable of generating data that companies and agencies can abuse. We preserve a place for privacy within public infrastructure. The eCash Act harkens back to the past, to the days when President Lincoln established the banking and cash system that we still use today, and it also harkens to an exciting, inclusive, safe digital future. We envision hardware devices, so those can be cards similar in size to an existing debit or credit card, or they can be secured SIM cards or something like it on a phone that would enable hardware-based transactions and for people to make payments as they do today with paper cash for everyday things without fear of government or corporate surveillance, which occurs in tandem when we use digital payments today. President Lincoln created cash after the Civil War in order to help everybody have day-to-day transactions throughout our economy. Today, we have cutting-edge technology in various other sectors in the government, including in the U.S. military, where they use stored value cards known as Eagle Cash in order to make offline payments. I would clarify that the point of eCash is that it does not operate online. It is actually open, permissionless, and private in the sense that you don't need a blockchain or a banking intermediary.
So that's one legislative proposal. But on the other side, here's Representative Tom Emmer of Minnesota, a member of the Blockchain 8.
The need to protect Americans' right to financial privacy is an all-time high. That's why I introduced the CBDC Anti-Surveillance State Act with over 50 of my colleagues. This bill prevents unelected bureaucrats from creating a tool for financial surveillance. If not open, permissionless, and private, like cash, a CBDC is nothing more than a CCP-style surveillance tool that will oppress the American way of life, and we're not going to allow that to happen.
So there's bills to make this happen, and there are bills to shut it all down. Clearly, there are wildly different approaches to legislating this topic being proposed right now in Congress, just showing how far from consensus members of Congress are on this issue. But politically, I will tell you there was a pattern. In general, the Republicans directed their questions toward the skeptics, and Democrats directed their questions towards the one guy who was in favor of the idea of a CBDC. And the biggest fan of the idea in Congress, Democratic Representative Stephen Lynch of Massachusetts, is starting himself a little club.
I'm announcing and inviting my colleagues to join the Congressional Digital Dollar Caucus. This forum will educate members on critical issues relating to the development, design, and potential implementation of a government-issued digital dollar. I plan to invite innovators, technologists, academics, and other experts to share their findings and development. I hope my colleagues will join me in this exploration.
And so things are happening in Congress. And if you have feelings either way about a CBDC, because honestly, I don't care much either way, since our money now, even the cash, is based on faith and tethered to nothing of actual value. But if you do care, the decision makers are clearly still in the decision-making process phase of this and kicking around a whole bunch of legislative ideas. Even the Federal Reserve itself is seeking commentary from the peasantry. Here's Federal Reserve Chair Jerome Powell back in March.
We did go out for comment in general on a CBDC a year or so ago, and I do expect we'll go out. I can't give you a date, but we'll certainly go out and engage. We engage with the public on an ongoing basis. Yeah. We're also doing research on policy and also on technology.
And so few Americans are aware that this debate is even happening, that, like I said before, calling your member of Congress about this and responding to the Federal Reserve when they ask for public comments again, if you are knowledgeable and you have thoughts, they could make a difference on this one. It's at least worth a shot. So Patreon did something weird. Patreon has decided to change their system. And it made it look like we had a really, really good 2 weeks. Because I told you in the last episode that back in May, I believe it was May, we finally hit 1,000 patrons, which I was super excited about. But when I was recording last week, we had 1,004, which means that the growth of support for this podcast has totally stalled out. And if you were to go on to Patreon right now, it looks like we have a lot more patrons than that at this point. And I actually got really excited because as of right now, it says publicly that we have 1,134 patrons. Oh my goodness, right? Like that's a huge jump. No. Patreon's just doing weird Patreon things and switching things around that were not broken. And what that is it's our total members, because apparently some people have signed up for the Patreon for free, which I didn't even know was an option, and I don't know how to turn it off. But right now we have 1,010 paid members. So I would like to thank the 6 people who have signed up to support Congressional Dish. But yeah, so the public stats are completely off. I don't know what that's all about. And since the last episode, support, it did go up a bit. But that is pretty much because of the payments of one person. And so I would like to thank our instant executive producer, Justin Becker, who sent in $535 in one Venmo payment for the last episode, 282, Chaos Fires McCarthy. And he said that he wanted to do this because it's an instant classic and told me to keep it up. And I cannot tell you how excited I was to get that payment. Like I said, Venmo has been in a major slump. Really all the digital, it's kind of ironic, right? That I'm doing a episode about digital transactions in the middle of a major slump where a lot of our one-time digital transactions have just completely dried up and I don't know why. And so to get one like that, like Justin, you made me feel very, very good. And I like that episode so much. I like doing the episodes that document real-time crazy things because I do feel like we're documenting history here. And wow, this period in history is completely crazy. I was just on Twitter. So I'm recording this on Thursday, October 19th. And we're in the period of all this drama where Jim Jordan is refusing to accept the fact that he doesn't have the votes to become speaker. So he's still fighting. I just find it very hilarious that Jim Jordan is such an asshole that he declared political war against people in his own party. And so he's probably not going to become speaker because he is just that big of a dick. So in that episode, Chaos Fires McCarthy, my nightmare scenario was a Jim Jordan speakership where I was like, Democrats, it could be so much worse than McCarthy. It could be Jim Jordan. But he's that big of a jerk that even the people on his team are like, nah, we can't with this guy. So, yeah, as of today, we still have no speaker. We are not closer to having a speaker. The House is still shut down. It's madness up there. But I'm not all that interested in the play-by-play. I'm more interested in the bills that are slowly being crafted while the House is closed, including one that would send $100 billion to our war efforts in different parts of the world. That's one that I want to read every word of. But again, the House is closed, so that bill doesn't technically exist yet. But I do think that when the Congress opens back up, I mean, the government has to be funded by November 17th. And so that, I think, is the latest that some kind of war funding and possibly authorization. There is talk of the House, I think it's House Armed Services Committee. It's Michael McCall, whatever committee that he's in charge of. But he is talking about creating an authorization for the use of military force, just in case it's needed because of this whole Israel situation. So we have a lot of crazy things coming up, but right now, I don't know. So I'm just kind of taking notes, and that's all I have for you for today. If you do want my thoughts on the Israel-Palestine situation, though, on We're Not Wrong, we've now talked about it for the last 2 episodes. And the first episode was an intense and very emotional conversation. It happened just a couple days after the initial terrorist attack in Israel. And so that was a tough conversation. And then in the second half of the episode that was dropped today on October 19th, we talk about it again during the email section. And during that, Justin and I were much more calm and thinking clearly. But yeah, so if you're curious about where I'm at on that, I'm talking about Israel and Palestine. So hopefully it doesn't destroy my career. I don't know why that particular issue, people just get so emotional and so upset. And yeah, it's a tough one to talk about, but we are on the brink of war. So I'm gonna. But anyway, thank you so much, Justin. And I'd also like to thank Philip Kaiser, who put an EP credit on the same exact episode. So within 2 weeks of publishing episode 282, Chaos Fires McCarthy, it is now moving up the most valuable episodes list with these 2 executive producer credits. And Philip said, quote, "It's such a great summary, and I've already learned enough before even finishing listening to the episode that I'd love to claim a producer credit for Congressional Dish 282, Chaos Fires McCarthy," unquote. So thank you so much for that. I would love to see that episode closer to the top. So you guys are definitely doing your part, and it's appreciated very much. And Robin Thurkel, who has been supporting the show for forever and a day, has an executive producer credit now on episode 281, Private Policing of the Organ Transplant Network, which, like I talked about at the end of the last episode, I was really anxious about because there was just no payments coming in. So to have another executive producer credit on that one, you guys are doing a lot for my mental health. And Robin sent in a message with her executive producer credit. And she said, quote, "I think I should have an EP credit that I'd like to use for the organ donation episode. I was supposed to keep up with all of the medical ones. I've graduated school, congratulations, and I'm an NP in community health. I love it, but the system couldn't be more broken than it is now. I'm kicking in a bonus for the firing of Kevin McCarthy just because. I'm listening to you and the guys considering joining the Patreon, but I just need it to be known that I am a Jen loyalist and only there for Jen. Keep it up." Thank you, Robin. I am happy to know that I have some fans on that show because some people hate me. So it's been an interesting ride to combine 3 audiences and just see the reaction because there's people that are Team Andrew, there's Team Justin, there's Team Jen, and some of the crossover just isn't there. Yeah, so I'm glad to know that some of my Congressional Dish people are over there supporting me in my debates with the boys. And it's so nice. So I'm recording this right now from Austin, Texas. We're getting an apartment and we move in tomorrow. And so I got to see Andrew and Justin. So this latest episode, we got to do it in person, which I think was really helpful for keeping our conversation about Israel just really level-headed. It just helps to be in the room, and it's so good to be back with my boys. So yeah, I'm loving We're Not Wrong. And if you haven't listened to it yet, I think this is probably a good time to start because all three of us we're excited the boys are traveling again. So they're going to take off to Europe for the holidays, but soon enough, we're going to be back together. We're going to pick some cities for a We're Not Wrong tour next year. So we're just really excited for election year, not necessarily because we think this is going to be a great election for the country, but during an election year, people start to give a shit about Congress and governing and politics and all of that. So we're hoping that it's going to be good for our new show, but we'll definitely have a lot to talk about, that's for sure. So I'm absolutely loving doing We're Not Wrong. It's one of the joys of my life. It's one of the highlights of my career. And so if you're not on board with that yet, go and check it out. But yeah, thank you for supporting this show if you are doing so. And if you're not, can you please? I know that there's plenty of people that think, oh, just take ads. But one of the reasons that you're able to trust me is because I have never taken any money from anyone in return for telling you anything. Even if it's something as simple as, oh, I like this product or this company or whatever. You need to be able to trust that I'm telling you the truth no matter what it is. And I do think that goes to simple stuff as well. So, yeah, listener supported is the only way that I'm going to continue doing this show. And if you want me to continue doing this show, even when it makes me mental, I do need your support. So thank you to all of the producers of the show. Thank you to Claire and Mike and Lauren for having my back on this. Yeah, can't do it without you guys. All right. I'm going to go run around Austin because I'm here and I'm super excited. So I'm going to go check out my new neighborhood and have no idea what the next episode is going to be because I don't know if we're going to have a Congress that's functional or not. So I will talk to you sometime in November, definitely before the regularly scheduled shutdown of November 17th. I will have at least one episode for you before that. And then we're just going to see what happens. Chaos! That's the only thing that's guaranteed. All right. Peace out. Talk to you later. Bye.
We're surrounded now by liars coming at us through our TV screens.
We don't have a domestic spying program.
They're content to fight in black and white despite the many in-betweens. We got a president who plays with the facts. And then he waves a flag to cover his tracks. As if a lie is alright, in the end will justify the means. Now we are so damn tired of being lied to.
The polar ice caps aren't going away.
We don't think we can deny it anymore. You can stick to your story if you think it lies. But we're not keeping quiet anymore. We are so damn tired of being lied to.
Government jobs consume the profits of the private sector.
We don't think we can deny it anymore. You can stick to your story if you think it flies. But we're not keeping quiet anymore. Now we're not keeping quiet.
These bills represent common sense, bipartisan solutions that actually solve problems.